So there's been even more China stories coming out this week than there was next week and the last couple weeks. Seems to be feeding on itself. Maybe it's the American financial media press, or maybe it's just that China, a lot of the banks in China, a lot of the corporations in China get a sense that things are starting to unravel. And so some of these entities are starting to go after money and credit outside the United States, and I'll talk about this in a second. So over the weekend, or later in the show rather, over the weekend, there was the story I talked about. It started on Friday about the small inter-Mongolian Chinese bank called Baoshang Bank that was publicly announced about a bailout. Well, Zero Hedge published another story today called, quote, a big wake-up call, end quote, Chinese bond market roiled by first ever bank failure. Late last Friday, Zero Hedge reported that several hours after the market closed, China's financial regulator and central bank made a shocking announcement. For the first time in nearly 30 years, China would take control of a bank, in this case, the troubled Inner Mongolia-based Baoshang Bank, due to the serious credit risks it poses. The news, which highlights the potential for increased stress at regional lenders that piled into off-book financing in recent years, was strategically timed to hit ahead of the weekend, and with the market closed, it avoided an immediate panic-selling waterfall. However, the fact that in China banks are now fair game for failure and will soon join the record surge in Chinese corporate defaults, and there's charts and all these things in the Zero Hedge article sourced from Bloomberg, slammed the country's financial sector on Monday, sending funding costs sharply higher and underscoring the potential for increased stress at regional lenders that piled into off-book financing in recent years. Unfortunately for Beijing, Bloomberg writes overnight that despite the strategically timed news, it wasn't enough to prevent turmoil from sweeping across the nation's bond market, where funding costs for lenders surged and yields on government debt jumped. The 7-day repurchase rate jumped 30 basis points to 2.85%, the highest in a month, as of late Monday night in Shanghai, while the yield on 10-year sovereign bonds climbed 5 basis points to 3.35%. Quote, Baoshang's case is a big wake-up call, end quote, said Becky Liu, head of China macro strategy at Standard Chartered. Quote, participants in the interbank market who didn't differentiate credit when lending to banks on the belief that they will never go bankrupt have now become more cautious. This has helped drive up funding costs and thus sovereign yields, end quote. So it sounds similar to what happened with LIBOR. I guess this is Chibor, right? So if remember how LIBOR rose a lot because the banks, which is the London interbank offering rate, the banks stopped trusting each other. Well, it appears that this is now the case in China too. And the trick of announcing a problem with a bank right on a Friday when most people are not paying attention, that's an American trick. So like I said, in my last live stream, China's copying the US in that regard. They're learning how to become more sophisticated with lying and market manipulation and all this stuff that the US and Europeans have done for a long time, especially the US. So, continuing with the article. Meanwhile, citing traders, Bloomberg also noted that the market is getting increasingly concerned that smaller banks may sell or refrain from buying government bonds because of difficulty getting funding, pressuring sovereign debt further, Liu said. While a full-blown bank run has yet to emerge, Baoshang Bank's negotiable certificates of deposits and other bonds were suspended from trading Monday morning. Analysts said the takeover will hurt market sentiment on debt, and shares of smaller banks and their issuance of NCDs, which is the negotiable certificates of deposits, could be harder from now on. The outstanding bonds of other city and rural commercial banks in similar situations could be sold off, China Merchants Bank said in a note. For those who missed our prior post on the bank collapse, here is some context. Founded in 1998, Baoshang Bank has more than 8,000 staff. I've heard 10,000 and reported total assets of 576 billion yuan or $83 billion at the end of September 2017. The estimates have been ranged from 20 billion to 60 billion now. This article, the old Zero Hedge one, said 83. So it's all over the map. A fraction of CCB's 23 trillion yuan last year. The smaller banks' so-called investment receivables, which analysts have said are often loans disguised as investments, stood at 153 billion yuan, accounting for more than a quarter of total assets. So could be more than a quarter of their total assets could be bad loans. Yet despite promises of recovery, with the Mongolian bank now insolvent, China's Caixin, Caixin, in English, reported that interbank creditors, hopefully I got the pronunciation close, interbank creditors with deposits above 50 million yuan may get back 70% of principal amount, and corporate creditors may get no less than 80% at early stage. More concerning is that depositors will also be burned. While small individual savings at the bank will be guaranteed by the government, corporate deposits and interbank liabilities above 50 million yuan will be negotiated, the regulator said on Sunday. Finally, the cost on China's one-year interest rate swaps, a measure of traders' expectations for liquidity conditions, surged 7 basis points to 2.82%. That's the largest increase in a month. Zero Hedge needs to get its grammar at her. There's multiple grammar problems here. In short, what has just transpired is a bailout with Chinese bail-in characteristics. So that's a mix of words there. Bail out and bail in together. I'll read that again. What has just transpired is a bailout with Chinese bail-in characteristics. And in other words, this may well have been the first domino to fall in China's banking sector, which earlier today reported a record 268.5 trillion yuan, or 38.9 trillion in liabilities, and 246.2 trillion yuan, or 35.6 trillion in assets, both up roughly 8% year over year, and well over double the size of the American banking sector. Perhaps the market is waking up that once the dominoes start falling, it will be next to impossible for Beijing to prevent a crash in the world's largest banking system. Well, we really need to see other dominoes start to fall. I'm adding in here from the article. So like I said, we need to see other dominoes start to fall. The rising interbank, Chibor there, for the rising interbank there, that may start to tell us that the banks are getting worried, which normally means the banks want to raise cash. They're not going to give out as many loans. Although the directives, there's a great book. I'm about 3 hours into it on the audiobook. It's called China's Great Wall of Debt, Shadow Banks, Ghost Cities, Massive Loans, and the End of the Chinese Miracle. I highly recommend it. Excuse me, sorry, my voice got a little sore there. I highly recommend it. It's on Audible audiobook. You can also buy the book. It's by Denny McMahon. He's Australian, I believe, and he grew up, and in a young age in Australia, he learned Mandarin, and he lived in China for over a decade. So, and he's worked for the Wall Street Journal and elsewhere. This guy has good credentials, good research. There's a lot of confirmation there of the similar story to the China Hustle documentary. He goes even more in depth on some of the stories. So I'm about a little over 3 hours into the book. Got about 5 hours, give or take, left. I think it's really good. I would definitely recommend reading it. Okay, let me get back to the article. Perhaps the market is waking up that the dominoes start falling. It'll be next to impossible for Beijing to prevent a crash in the world's largest banking system. It's also why the debt sold offshore by Chinese small banks to help meet capital requirements also fell, with Bank of Chongqing's 750 million additional Tier 1 note was down 0.8 cents on the dollar, the biggest fall since March 20th, to 94 cents. So securities from Bank of Zhengshu and Huishang Bank also dropped. If, or rather when, more banks suffer Baosheng's fate, the drops will be far greater. Yeah, so see, we have to see evidence that more. So this could just be the first tiny bank. I was talking with my buddy, my best friend, who's now a real estate agent, but he had a job many years ago right out of college, and he was involved in, the mortgage lending stuff. Subprime and mortgage lending and other, ridiculous stuff that was involved, like 2004 to 2007. And I was asking him back then about his experiences dealing with firms that failed, and he was just telling me that there was a bunch of signs with smaller firms failing from 2004 to 2007, and people like Ben Bernanke and the Wall Street banks and the larger mortgage companies just ignored it. They were saying like, oh, it's just a one-off, it's not a big deal. So we just have to wait to see if that actually does happen with more Chinese banks falling. Now we'll see if China actually wants to announce it. Because now that that could have been a test. And now that they announced one and saw how bad things are, they might not announce anymore publicly. Okay, back to the article. Ironically, Baosheng was once seen as, quote, as a model for funding China's regional economies, and, quote, according to Bloomberg, is one of many smaller Chinese lenders that obscured its exposure to risky borrowers by tapping into the country's shadow financing system. And while China has been cracking down on such behavior, but UBS Group AG analyst Jason Bedford said the country is rife with regional banks that use special purpose vehicles to circumvent lending restrictions and hide the true state of their bad loans. So do the municipalities. The municipalities, I'm also learning from this China's Great Wall of Debt book, the municipalities also created secret corporations to get around rules to continue borrowing and growing with debt. The municipalities a while ago were not supposed to be able to borrow nearly as much, and so one of the ways around it was they created these these dummy corporations and then went to the banks and borrowed. And I'm sure the banks knew. Okay, let me see. What is even bizarre is that, as we noted last week, the bank's official non-performing loan ratio was then only 1.68% as of December 2016. That in itself would never have been sufficient to force a takeover, and suggests that not only was the bank's real bad debt ratio much higher, but that China continues to chronically underrepresent the true state of its non-performing loans to avoid bank runs. So I've heard, there was an article, I talked about this a year or two ago, from the South China Morning Post, and there was a either current or former, I think there was 2 interviews. There was one from the head of the People's Bank of China, and he was saying that too many loans are being given out for speculative real estate, and that 60% of their GDP now was in real estate and speculative real estate and construction, way too much. And then another was from a former PBOC banker, and he said, I think he was a consultant now for real estate companies, and he said he was worried that there was over 40% non-performing loans, not that low number that this Chinese bank claimed. He said the whole industry-wide, it's over 40% non-performing loans, but I've heard estimates of 60% or higher non-performing. But a lot of people assume that as long as this RMB denominated debt, that the debt will get wiped. It appears that this might not be a good assumption. Okay, so that in itself would not have been sufficient to force a takeover, and suggests that not only was the bank's real bad debt ratio much higher, but that China continues to chronically underrepresent the true state of its non-performing loans to avoid bank runs. Yes, I reread that. Whatever the underlying ugly truth may be, it's not as if investors and depositors weren't warned. As discussed here extensively in 2016 and 2017, they highlighted other articles. Regional banks in China's Rust Belt drove the rapid expansion of non-traditional lending that peaked in early 2018. As a result, smaller firms who used shadow loan instruments to diversify from their struggling home provinces exposed themselves to a much wider spectrum of Chinese corporate risk. Now that the shadow bubble has popped, banks are now getting squeezed as Chinese companies default at a record pace and financing costs for shadow lending activities increase. As part of the government clampdown, banks have been forced to reclassify loans overdue for more than 90 days as not performing, a move that led to a record surge in sour debt and wiped out capital at some small lenders, Bloomberg reports. Now that Baosheng is insolvent and the de facto canary in Chinese bank failure coal mine, there will be many more in parenthesis. The question is how to restructure its insolvency balance sheet. The bank has more than 60 billion yuan of negotiable certificates of deposit and 6.5 billion yuan of subordinated bonds outstanding, according to data compiled by Bloomberg. Trading in the company's NCDs and other bonds was suspended on Monday, people familiar with the matter said. So why do NCDs matter? Because as we explained as far back as 2 years ago, in the most recent troubling trend involving Chinese banks, numerous small banks had become acutely reliant on such shadow banking funding mechanism as certificates of deposit, which had become the primary source of short-term funding for many of China's banks, mid-size and smaller banks. As Deutsche Bank further explained, the banks most exposed, there's a bunch of good charts here in this article. You'll get a link to it after the show's over in the information section. The banks most exposed to a shutdown in this, quote, shadow funding pathway are medium-sized and small banks, for whom, as of first half 2016, wholesale funding made up 31% and 23%, a number that has risen substantially in the interim period. And with the Baosheng domino now down and the interbanking funding market suddenly freezing, Friday's announcement will put shares of other Chinese banks under pressure, according to Sanford C. Bernstein. A Bloomberg Intelligence Index of Chinese lenders dropped almost 1% on Monday to a 4-month low. Predictably, ICBC, the nation's largest lender, dropped a little bit also in Hong Kong. Not a full percent, about 0.5%. Some tried to put a positive spin on the shocking failure. Quote, low-quality small regional banks are unlikely to pose systemic risk to the financial system or the operations of the big SOE and joint stock banks, end quote, said analysts Linda Sun Madison and Jason Lee in a note on Monday. Quote, however, the bail-in of Baosheng Bank, a rare move by the government, and the involvement of CCB will no doubt heighten the investor concerns over SOE banks' risk exposure to national service, end quote. Translation, nobody knows yet if this bank failure will result in a bank run, even as the market is clearly recoiling from the bailout. If a bank run does indeed materialize and some of those 35 trillion in Chinese bank liabilities, i.e. deposits, flee, well, not only are all bets off, but Trump can celebrate an early victory in the U.S.-China trade war. I don't know if I agree with all that stuff there at the end, but I think that is a major reason with the banking scare why. Let me pull this up real quick. I forgot to pull this up. Let me go get the Bitcoin price. That's why the Bitcoin price spiked. That's why the market cap has gone up so much. The Bitcoin price is rallying. Other cryptocurrencies have rallied quite a bit. I think a lot of it is because people are starting to pull their savings out of the other Chinese banks, and there is capital controls in China, but there's a lot of STEM people, science, technology, engineering, math people in China, and they are figuring out ways to get their money out of those Chinese banks. Okay, next story. If you want to read this more and look at all the charts and graphs, I will attach a link to the article. Next story. So China warns, this was yesterday, China warns traders of, quote, huge loss if they short the yuan. This is from Bloomberg. China advised traders against shorting the yuan after a recent slide took the currency to the brink of the critical 7 per dollar level. Guo Shuqing, head of China's banking and insurance regulator, said in a speech that speculators, quote, shorting the yuan will inevitably suffer from a huge loss, end quote. The speech, delivered by a spokesman for the agency on Saturday in Beijing, also included comments on the trade war, making Guo the highest level financial official to publicly comment on the issue since tensions between China and the U.S. escalated this month. Most local media ran front-page articles on the speech. The broadside comes as bearish sentiment on China's currency ratchets up, thanks to trade tensions and signs of a stuttering economy. The offshore yuan, which briefly strengthened Monday past 6.9 per dollar for the first time in 8 days, has weakened about 2.6% this month. A gauge of traders' willingness to bet on further declines has surged to the highest level among Asian currencies. When it comes to burning speculators, China has a good track record. In January 2017, when officials grew upset about the yuan's weakness, they choked cash supply in Hong Kong and sent the currency's deposit rates to record highs. That helped drive a rally in the offshore yuan. Traders have turned more bearish on the yuan in recent weeks. The offshore currency's 3-month risk reversal, which measures the extra cost of bearish options over bullish ones, has increased 5-fold this month, according to data compiled by Bloomberg. China doesn't want, quote, too crowded trades, and, quote, betting on a one-way movement of the yuan, as its main concern is growth, and a stable yuan is important to achieving it. Alicia Garcia Herrero, chief economist for Asia Pacific with Nataxis, wrote in a note last week, should investors speculate on one number, the central bank is likely to make them pay, as it has done so in the past, according to the note. What I would add in is China had more reserves to defend its dollar peg and fixed exchange rate and manipulate and do other things. They had a lot more reserves in the past. They were running much larger trade surpluses. They had much more money in reserves, around $4 trillion, according to Kyle Bass. This is no longer the case, especially on the total trade reserves front. And the tariffs are going to start hurting their trade surpluses, especially with the United States. Okay, continuing with the article, the central bank can use instruments ranging from counter-cyclical factor in the yuan's fixing exchange rate to reverse requirements for yuan deposits offshore to defend the currency, according to Bloomberg economists David Xu and Chang Xu. It fixed the reference rate at a level that was slightly stronger than expected on Monday. In the speech, Guo also said that yuan's weakness caused by the trade war makes the U.S. government worried about the diminishing effects of higher tariffs. The speech also said it was, quote, ridiculous, end quote, that developed countries have long asked for more currency flexibility, but when the yuan's rate becomes more market-oriented, some of them showed fear. This sounds like spin here because China is, according to my sources in China, my news source in China, I just been speaking to at length lately for the last week or so, who reached out to me and asked that, don't mention their name, but living in China over a decade, friends with really high-level people in China, and my source said that China is really worried about the RMB, the ratio of the US dollar to the Chinese yuan, if it gets to 8 or 9. That there would be a lot more inflation accelerating, a lot higher inflation in food and rent. Supposedly inflation in food and rent is already picking up. If you look at charts on the US dollar to Chinese yuan or RMB exchange rate, it's really started to spike around, let's see here, the end of April and early May. So it wasn't doing very much. It was at 6.68 for a while, for months, and didn't do very much. And then all of a sudden, Trump announced that there was no progress with the trade deal, and we knew there was no progress, that he was lying. And then all of a sudden, the exchange rate the 2-month chart just looks like vertical. It's starting to go vertical. But the 35-year historical chart is really weird because of all the manipulation by the Chinese government involved. So there's vertical straight lines there with changing the exchange rate. And then there's also like a total flat movement there, or very little movement at all. But recently there's been more volatility. There's more, I can tell you on the 35-year chart, there's more volatility in the last, let's see when that was. There's more volatility, according to this chart, in the last 3 or 4 years than there's been in a long time. There's a lot of volatility up and down now on this chart for the 35-year chart. And finally, the story on Alibaba. So, yesterday Alibaba announced they're reportedly eyeing a Hong Kong listing to raise $20 billion. Alibaba is reportedly working with financial advisors to raise $20 billion via a second listing as early as the second half of 2019, sources tell Bloomberg. The Hong Kong-based offering would come after Alibaba in 2014 raised $25 billion on the New York Stock Exchange in the globe's largest first-time share sale. So this is very interesting because I started taking a look at Alibaba's financials. And first, let me bring up that Jim Grant of Grant's Interest Rate Observer is one of the most respected investment newsletters on Wall Street, and they have a Grants conference, right, where they have long ideas for investments, short ideas. They bring global macro people in. Jim Chanos presents there. I think David Einhorn may even present. There's a really big name of people. It's a big deal. I think it's like $5,000 to attend each conference. And they were talking, I think, in the last conference about accounting fraud at Alibaba. Now, I didn't spend a massive amount of time on Alibaba here, but I only spent about 15 or 20 minutes, but I already see a lot of red flags on their income statement and their statement of cash flows. And this is not going through their SEC filings and comparing their SEC filings versus their main investor stuff that's released, because if you do that and you see that the SEC filings are very different than their normal investor material, then that's a red flag. And that was brought up actually in this new book I just finished called Saudi America by Bethany McLean. The shale oil companies were drastically overstating their economic reserves to investors. Some of these shale oil companies were overstating their economic reserves by tenfold. And there was other phony accounting and lies and stuff like that. So first of all, if you're not familiar with Alibaba, it's BABA, like Baba. And it has a $401 billion market cap. And they supposedly, according to their balance sheet here, for cash and cash equivalents, they have almost $190 billion worth of cash. They have another, $13 billion worth of short-term investments, so they should have a lot of cash, okay, or liquid investments that could be converted to cash. And yet, now let me go to their statement of cash flows and their income statement. There's some red flags here. So they have really large net income. I'll go to their income statement first. So they have really large net income. Their gross profits are pretty large. What is a red flag to me, and I can't remember seeing this, and I've looked at companies in different industries, and this would be a red flag to me, is that normally with a company, when you look at the income statement and you look at total revenue and you look at gross profit and then you look at operating income or loss, normally it goes revenue's larger, then gross profit, and that's your gross margin. So the gross profit divided by total revenue. And then you're looking at the operating margin or operating income. And Alibaba, the red flag I see with Alibaba is in a lot of cases, their net income, normally their net income is, with most companies I've looked at, and I've looked at thousands in different industries, different companies, different industries. Normally the net income is smaller than the operating income. And with Alibaba, in a lot of cases, and I'm only looking back like 3 years, that's not the case on a lot of their income statements. So I would call that a red flag. I would call that there's some type of games there. Because with most companies, their gross profit is larger than their operating margin, and then their net profit margin is smaller than their gross profit margin and their operating margin. And that's not the case with Alibaba, okay? What's the case with Alibaba is the net income just looks massive, which is weird. And now when we take the net income and we go to, if you're not familiar, you take the net income and you start plugging it into the operating cash flow. And when I look at operating cash flow, the operating cash flow numbers look fine. However, when you start looking at the CapEx and the investments and the other stuff, there's some weird things going on. Oh, the other point I would make is that the operating cash flow is changing pretty variably with the net income. So in certain cases, when you have $71 billion in net income, the operating cash flow in 2016 was down a lot. And then it's back up magically in 2018 with a little bit less net income, up to $125 billion in operating cash flow. So there's red flags here in the operating cash flow as well. Normally you want to see pretty stable operating cash flow, and in this case there's not really. There's not stable operating cash flow, so there's red flags here as well. The average person, the average retail investor is not going to notice this stuff. To do more work on this, for hedge fund level work, you would have to start comparing the SEC filings versus their public filings. And on top of that, you would have to start looking through all the disclosures in the annual report. This is the really fine print stuff. So if it's like a 100-page annual report or a 50-page quarterly report, this might be something in size 8 font in a paragraph on one sentence under credit risk, or a footnote on page 8 out of 50 or something. And that might be the truth where you're going to find things. So there's a lot of red flags here with Alibaba. Meanwhile, with Alibaba, they've raised $45 billion. They're going to raise $45 billion, which is about 10% of their market cap, in only about 3 or 4 years. And according to their public financial statements, they should not need this type of capital raise. So I think this has to do with what Miles Kwok said. If you're familiar with the Real Vision television interview, with what he said, and Miles Kwok's not his real name, he's a Chinese billionaire, what he said about Jack Ma and how the CCP has basically taken over Alibaba, and that Jack Ma is, I think, either under arrest, I think he was arrested recently, but that him and his family together could not leave the country. So there are a lot of red flags in Alibaba. The stock has actually gone up the last couple of years, but I'm telling you though, even though stock's gone up and there's headline numbers that look good, beneath the surface there are red flags. Wow, we got a bunch of trolls here talking about how good it is to buy Deutsche Bank. I would not buy Deutsche Bank. I'm not sure I'd buy any bank stock at this point, to be honest. Wow, I can't believe all the posts here. Someone must not like me. Okay, I'm taking a look at the questions and comments. Doesn't seem to be a lot of... It's mostly about Deutsche Bank. Yeah, the currency swaps are... I see someone mentioning my currency swap show. The currency swaps, according to my sources, never stopped after 2008. They never stopped. So they've been bailing out the European banks and the European governments for almost 10 years. About 10 years. And in spite of the currency swaps, and we don't know the real number. We're not going to find out the real number unless it gets announced, maybe. I doubt it, though, because we're not going to get a real audit of the Fed. And in spite of that, the European Central Bank still had to change its laws, increase quantitative easing, which they weren't supposed to do until they had the laws changed, and then massively increase their balance sheet to over $5 trillion worth of assets to buy European corporate debt, European bank stuff, garbage, probably derivatives, and then also probably bad European government bonds. There's rumors they may start buying up all the Italian government debt too, because Italy's looking like it's going to be in the worst shape. And that's why Italy did the deal with China out of desperation. That's why they joined the Belt Road, or whatever the new name of the project is called. Italy fell for the Chinese debt trap, even though Italy already had tons of debt. Italy, was the first G7 country to join? And then New Zealand followed pretty quickly after that. But New Zealand's closer to China. So, China has an enormous amount of influence in Australia and New Zealand now because of how close it is. Yeah, so if you're a hedge fund manager and you want to do the due diligence, start taking a look at the Alibaba financials. They do not make a lot of sense. This company, according to their documents released, their public financial statements, they do not need to be raising $45 billion worth of capital in 3 years. They're making that much net income, that much cash flow. Their management is either incompetent and misallocating lots of free cash flow, or their numbers are nowhere near as good as claimed, and it's a piggy bank for insiders to just steal. And from what I've heard, there was a lot of insider selling in the past. I haven't checked recently. There are not a lot of good rare earth stocks. That's the problem. There's just not. The miners, I was discussing this with a hedge fund friend of mine, and she was naming off all the junior miners, the rare earth ones, and I was telling them, oh, so they're going to be able to get all the permits to store the thorium. Most people think that building a rare earth mine is very similar to building a gold mine or a silver mine or a copper mine. It is not. It is even more painstaking. The permitting process for rare earths is very similar to building a uranium mine because there is radioactive materials involved. Some of the rare earths are radioactive, and in almost all the cases with rare earths, thorium is a byproduct. And with every government, you have to find a place to store the thorium. So you have to pay extra money, which means higher costs involved, to store the thorium. Because unfortunately, the world is not using thorium efficiently. Thorium is not being used with Lifter to recycle spent nuclear fuel rods and old nuclear weapons, which is what it should be. Do I think they will allow Deutsche Bank to fail? It's a good question. There might be some type of restructuring. Just wipe out the shareholders. Deutsche Bank has so many derivatives positions, though. I don't think that they can let the derivatives positions fall. They can wipe out the equity, but the other things that Deutsche Bank has, like the derivatives positions, I don't think that they can let those fall. But I think the equity holders will get wiped. Totally wiped. Okay, well, we're at 33 minutes, and there's a lot more questions coming in. But I'm going to take a break for now. There's a baseball game I want to go watch, go relax for a little bit. I want to thank everyone for... Wow, this troll is just getting out of hand. I had to block him. He just said some derogatory stuff. It's just getting ridiculous. There was like 20 posts of this nonsense here. Cluttering up the message boards. Don't feed the trolls, right? Okay, well, that's it for today's show. And any more questions or discussions about China or the RMB, you can talk after the show in the comment section. And I will attach links to the articles I mentioned in the information section of the show after it's over. But there are a lot of red flags with this Alibaba capital raise. Let's just put it that way. Based on their financial statements, they should not they should not need to raise $45 billion in equity in only 3 years. If their financial statements are true, this company does not need to raise equity at all. So I would count that as a big red flag. Sounds like insiders want to get out. or the whole thing, there's just a bunch of hidden problems with the company. It would take a lot more work, to hours and hours of work, to figure this out. But I know hedge funds have looked into this, and there are some that think that it is a fraud already. I just haven't spent the time. And on a free podcast, it's just not worth doing. Making a couple bucks from Google ads to do it. Okay, guys, well, that's it for now. And everyone have a great rest of your week. And if there are stories, hopefully there's other stuff that's non-China related. Although we are seeing a lot of inverted yield curves now, because these governments can't pay the interest rates on their debt, right? So they need to manipulate the yield curve. I'm just seeing tons of charts and graphs lately about all the yield curve inversions in the US, the global yield curve inversions and all this stuff. But this is the definition of financial repression. This is when governments, they borrow too much money, they can't pay the interest payments on the debt, and this is what you get. You get the end game, not of capitalism, you get the end game of Keynesian, neo-Keynesian, and Keynesian economic central banking. And you know what? They will blame capitalism, and hopefully we will be able to tell them that they are wrong. The people are blaming capitalism, because none of this that is happening now with the interest rate manipulation is capitalism. There is no market for interest rates and bonds. It is being totally, totally manipulated.